Gold just had its worst quarter in 13 years. And the people most surprised by that are the ones who thought they understood what gold was for. Here is the uncomfortable truth. Gold's reputation as the ultimate safe haven was always conditional, and right now, the condition that kills it is active. The question you need to answer before you make any move is this. Are we watching a temporary dislocation, or is a multi-year repricing of bullion already underway? The answer depends entirely on one institution, and it is not a central bank that holds gold. Let's establish the facts precisely, because this story is being misread in a lot of places. Gold just closed its worst quarter in 13 years. That is not a rounding error. 13 years takes you back to 2013, which was the last time the Fed began telegraphing a pivot away from crisis-era monetary policy. The parallel is not accidental. The headline driver, according to reporting from CNBC, is interest rate fears hitting bullion. Note the word fears, not a confirmed rate hike, not a policy announcement, but anticipation. That distinction matters more than most coverage acknowledges. Markets are pricing in a scenario, not reacting to a fait accompli. And when markets price in scenarios, they can be wrong, sometimes dramatically. Here is the mechanical relationship you need to internalize. Gold pays no yield. It produces no cash flow. Its entire value proposition is relative. It holds purchasing power when the alternative of holding dollars feels dangerous. The moment interest rates rise, or even credibly threaten to rise, cash and bonds suddenly offer real returns. The opportunity cost of holding a zero-yield asset like gold increases in direct proportion to that yield. Investors do the math and rotate. This is not speculation. This is the documented mechanism that crushed gold in 20,000. And it appears to be the same force at work in mid-2026. The losses eased slightly as the week progressed, but easing is not reversal. What you are watching right now is a market still in price discovery mode, trying to determine where gold belongs in a world where rates may stay elevated longer than the consensus assumed. That recalibration takes time, and it is rarely clean. Now let's talk about something that is running parallel to the gold story and is arguably more instructive. Japan spent $74 billion intervening in currency markets to prop up the yen. $74 billion. That is not a rounding error in sovereign finance. That is a significant, deliberate, and expensive commitment by one of the world's largest economies to resist a market outcome it does not want. And yet investors, according to the same reporting, are saying clearly that the real battle is not between Japan and currency speculators. The real battle is with the Fed. This tells you something precise about how global capital is allocated right now. The Federal Reserve's rate posture is the gravitational center of the entire system. When the Fed signals that rates could stay high or go higher, dollar-denominated assets become more attractive. Capital flows toward the United States, and every other central bank has to respond, either by raising their own rates and risking domestic economic damage, or by intervening in currency markets and burning through reserves. Japan chose the second option, $74 billion worth of the second option. For gold, this dynamic is doubly negative. A stronger dollar makes gold more expensive for foreign buyers because gold is priced in dollars globally. When the dollar strengthens, which it tends to do in a high-rate, high-demand environment, gold faces selling pressure from an entirely separate mechanism than the opportunity cost argument we just discussed. You are getting hit from two directions simultaneously. Domestic investors rotate out because rates offer yield, and international demand softens because purchasing power for foreign buyers decreases in their local currency terms. Understand this structure, and you understand why quarters like this one happen. It is not irrational panic. It is rational reallocation responding to price signals. This is not financial advice. It is an explanation of how the mechanism works. Here's where most coverage stops giving you anything useful, so let us go further. The question is not whether gold had a bad quarter. It clearly did. The question is what that quarter reveals about the conditions under which gold actually works as an asset, and how to position your thinking going into the second half of 2026. Gold's core use case is purchasing power preservation in environments where monetary policy is either credibly loose or structurally unreliable. It performed exceptionally well during the zero-rate era because the opportunity cost of holding it was near zero and the implicit threat of inflation was real. Both of those conditions have meaningfully changed. So what would need to be true for gold to reclaim its footing? One of two things. Either rate expectations shift, meaning the Fed pivots, or signals that cuts are coming sooner than priced, and the opportunity cost argument reverses, or geopolitical and systemic stress intensifies, to the point where the safe haven premium overrides the rate math. That second scenario is the one that catches most investors off guard, because it tends to arrive without a warning label. What you should not do is treat a multi-decade asset allocation decision around gold based on a single quarter's price action in either direction. The same logic that says, do not buy gold because it had a good quarter applies in reverse. The honest, analytical position right now is that gold is repricing to reflect a specific macro environment. That environment could persist, and the next significant catalyst is almost certainly going to come from Federal Reserve communication, not from anything happening in the gold market itself. Watch the language in Fed statements. Watch real yields, which is nominal yield minus inflation expectations. When real yields fall, gold tends to recover. When real yields rise or stay elevated, this pressure continues. That single variable does more explanatory work than most of what you will read in financial media this week. Track it accordingly and make your own informed assessment, because this is not financial advice, and anyone telling you they know exactly where gold goes from here is selling you certainty they do not possess. Gold's worst quarter in 13 years is not random noise. It is a precise readout of what happens when the dominant monetary force in the global system, the Federal Reserve, signals that easy money is not coming back on schedule. That open loop we started with? Here's the honest answer. Nobody knows if this is a temporary dislocation or a multi-year reset, but now you know exactly which variable to track. Next video, we are going inside what real yield inversion actually predicts across asset classes. Subscribe so you catch that one.